Hi guys, welcome back to our next class. In this class, we'll be learning about the risk and reward entry. I'm not going to say a lot about risk and reward, just a brief one so that we want to make sure that our reward is always higher than the risk. So let's get started. So what is risk and reward ratio? The risk and reward ratio is used to assess the profit potential, which is the reward, of a trade relative to its potential loss. Both the risk and reward of a trade are based on lines that are set by the traders. So the relationship between these two numbers can tell you whether the potential reward outweighs the potential risk or vice versa. This can help you decide whether the trade is good or not. So what it says here is this. There's a risk, right? And then there's a reward. Okay. So to identify whether a good trade, we must always have a high in reward and lower down our risk. So whenever we start trading, before we even entry, we must always calculate the risk first. Okay guys? Risk first we calculate, then we calculate the potential reward, then only we will measure it. So let's have a look at the next chart. So how do we measure risk and reward ratio? There are only 4 steps, so very easy. This is called the triple R. We evaluate the potential price levels for your stop loss. It's always measure your stop loss first. So how much pips is the stop loss? And the profit targets. And how many pips is the profit target? We measure between the distance of your entry and your stop loss. That is your potential risk. And we measure the distance between your entry and your profit target. That is your potential reward. So the potential reward will be at the top. Potential reward, okay, divide by potential risk. We want to know the ratio. Okay, so let's have a look at the example. So let's look at this example. Let's say you expect to make $100 profit. Your potential profit will be $100, and then in such a way that you are willing to lose just $25 of your equity. So we put $25. Okay, so $100 we potential gain, our potential reward, and our potential risk means the stop loss will be around $25. So 100 divided by 25 is equals to 4. So your risk reward ratio would be 4 to 1. You risk 1 and then your reward will be 4 times than what you are risking. So this is a very good trade. Why do we need to have a higher reward and lower risk? Let me show you in the next slide. So here we can see we have 10 numbers of trade. So let's say your risk reward ratio is 1 to 1 over 1 all the time. Meaning to say that you are risking $100, but your reward is $110. So you lost 5 times and you win 5 times. In the end of the day, after your 10 trades, you only have 50% winning rate, isn't it? 50% win rate. So when you have 15% win rate, it's actually quite good. It is considerably good enough. Why? As long your reward is higher than the risk, then you are fine. Okay? Because when we win $550 in total, we are only losing $500. In the end of the 10 trades, we still gain profit of $50. So guys, remember, whenever you measure your risk reward must always higher than the risk. It doesn't matter. You see like this, the reward is only 10% higher than the risk, which is $10 higher than the risk. Doesn't matter, as long it is reward higher, risk lower, you are considerably safe. So in conclusion guys, remember what I've been keep saying, the risk is always lower than the reward. So in this case, the risk is higher than the reward, we do not want to trade. It's not worth it. Secondly, if the risk is equals to the reward, I would say I would never take this trade as well. Okay, just be careful, cautious. And thirdly, when the risk is much lower and the reward is much heavier, then this is considered a very good trade. So in this risk reward topic, I'm just gonna keep it short. Most important, guys, just to tell you that the reward must always higher than the risk. That's it. So I'll see you at the next class.